I think that the change in the market since the GFC has really been the biggest change in the industry. And it's driven by a couple of things. One is the supply and demand of capital to private companies, and then also the growth of the traditional LP community in terms of their abilities, and particularly their abilities to go directly into deals. And so you've seen this stage by number, fairly small proportion of investors who have internal direct teams, or the teams or the capabilities are outsourced to advisors, really co-investing in transactions or doing their own direct transactions. And that's something that we haven't seen on that scale since before the GFC. In the old days, there were private companies, there were the LPs, and then there was a very sort of uniform group of managers, and around those managers, gatekeepers and advisors and fund of funds. And then with the arrival of the financial crisis and the change in supply and demand of capital, that very, very cohesive universe fragmented. So there were some managers that could raise money as much as they really wanted on the old, let's call it 2 and 20 fee structure. There were some managers that had sort of overstepped their bounds and probably wouldn't be able to raise a fund in between. And then there's a manager universe in between that tried to raise whatever capital they could under the old sort of 2 and 20 fee structure. And then either they would look for separately managed accounts or look for co-investors in order to be able to do the deals that they wanted to. And a couple of other things had happened. One is that the GP community globally had grown from about sort of 2,000, I think was the number that I used to use in the early 2000s, to 6,000. So you have a lot more choice, a lot of managers willing to operate under these new fundraising rules, if you want to call them. And at the same time, you had investors who either were still reliant on managers to do deals, so it wasn't necessarily syndicating transactions that had happened in the past, but they might co-underwrite deals. And then particularly some of the Canadian and the Asian government-owned institutions looking to do deals directly. I think that's still being figured out. So for some managers, they now really focus on a scale discount. So to attract the big investors, they'll say, if you commit above 100, 200 million, there's a sliding scale on fees, particularly for some of the big funds. Or enter into a large separately managed account, and you see, State of New Jersey, for example, publicly available information, they did a large separately managed account with a US manager. And then sort of anything that's kind of in between on that is very sort of customized relationships with particularly the bigger investors. Well, you're seeing a whole bifurcation of the investor community as well. So I think it's unclear what the end game is, but some of the Canadian LPs have basically scaled back or wholly exited the fund investment part of what they used to do, and now wholly focused on doing direct deals. Others, it's more of a hybrid approach. I think if you're running a global portfolio from Toronto, I think it's actually quite hard to try and cover everything. But that's our own view, and we sort of try and figure out what works for us. Some of the US pension plans have to have an advisor by mandate, but increasingly they're figuring out how they can do co-investments. And one of the Californian ones have actually recently released data on their co-investment portfolio, and it's done really well for them. So I think now they're also able to go back to their boards and say, look, so far so good. Give us more capital or give us some more leeway in terms of what we can do in this more direct universe. Well, we started co-investing in 2007, and the program started in 2005. And we were fairly slow on co-investments until the financial crisis, so we did 2 before. And then since the financial crisis, we've done 15 deals. So I think that we have found a strategy that works, and we very much believe that it's a close partnership with a select group of managers. And we're also more focused on sort of middle market and growth transactions. There are many unique aspects to the Australian community. But one is that a lot of the programs that were started here in the late 90s, early 2000s, the entire allocation went into Australia, which is only 2% of the global market. A lot of it was outsourced, and also there's a very, very big focus on fees. And so I think that sort of had a certain type of portfolio that was constructed, and then some people went overseas kind of at the wrong time, and with not that much internal experience in the teams. There are some programs built that way that didn't satisfy the fiduciaries and the boards, and those programs have been scaled down or closed. There are some programs that actually have been working okay, but people have looked to other types of ways to build and construct a portfolio, and now the new money is going into that as well. And I think that since 2 or 3 years ago, we've seen a resurgence in demand for private equity amongst the Australian institutions, but it's much more now using co-investments, which are more available since the financial crisis.